It's the first Tuesday of the month, which means it's almost time for the Reserve Bank to reveal any changes to the official cash rate. We'll have that announcement for you shortly. And here to discuss what the RBA is considering is finance reporter Sue Lannin and also John Noonan from Thomson Reuters. So, John, let's start with you first of all. No changes expected today, is it?
No. The latest survey from Reuters that they completed this morning, 60 economists surveyed, 60 saying they're going to stay on hold. In fact, a vast majority think they're going to stay on hold for quite some time. The interest will be in the statement to see if there's any shift in bias. The last statement was very neutral. But I expect them to remain neutral as possible. They're not going to introduce, I don't think, easing or a tightening bias at this stage.
So, the big banks have started to raise their interest rates independently of the Reserve, targeting specific areas of people.
That's right. We've seen recently all of the big banks raise rates. They're specifically targeting investor loans because that's where a lot of the heat in the housing market's coming from. They're also targeting interest-only loans, which have been taken out by both investors and owner-occupiers, often by people that can't afford a deposit or can't afford to pay back the principal, so therefore they're just paying back the interest. But the Reserve Bank has identified that as a risk, one of the risks building in the housing market. They mentioned in the last minutes that investors had, investor lending, borrowing had picked up in the last few months, especially of 2016. So yes, as you said, all the big banks, but we've seen some smaller lenders as well also target investors and interest-only loans.
John, taking the housing market out of it, how's the economy looking?
It's a bit uneven. I mean, as the RBA said in their last statement, the unemployment, the labour sector is a bit mixed. A lot of part-time jobs are being added, but not the full-time jobs aren't as strong. And what's really probably concerning the RBA the most is the fact that inflation remains stubbornly low. They'd like to see inflation, underlying inflation, get to their target between 2% and 3% at some stage. And that's one of the reasons that they won't move on rates for some time until they see evidence that that's clearly going to happen.
So were it not for the housing market, they're probably lower rates.
Yes. There's a possibility that they could. In fact, I think if anything, they would have an easing bias. But of course, they don't want to fan the flames of an already red-hot housing market in Sydney and Melbourne specifically. Not in the other capitals. I mean, Perth and Brisbane, not as strong there, Adelaide. But Sydney and Melbourne are red hot, and they're afraid of household debt, as Sue mentioned.
Well, that's right, record levels of household debt right now.
Exactly, and that will affect the consumer. We saw retail sales.
We've just heard that the interest rates have been left on hold as completely expected. Sue, we'll come to you in a moment when you've had a chance to look at what the accompanying statement says. What about future moves? Rates aren't expected to move anytime soon, are they?
We certainly don't expect them to move for quite some time because we don't see inflation coming back to become a problem for the RBA where they're going to have to move it. And they'd be very, very worrisome to do so, particularly with parts of the economy looking a little bit fragile and a little bit uneven. And as far as lowering rates, again, they'd be worried about the housing market. And also, too, the RBA wants to keep room. Now, it's interesting in the Reuters survey, there's about 8 or 9 economists who think the next move is going to be up, and they give housing as one of the reasons for that. And then there's about the same number who say the next move is going to be down. But the majority of economists think they're going to stay on hold through 2017 and perhaps right through 2018 as well.
What a change that is, because a couple of months ago, everybody thought the next one was going to be up.
That's absolutely right, but I think it's the inflation numbers, and we get those again at the end of this month. And unless we see some pickup in inflation, the RBA is going to be very, very hesitant to even think about hiking rates.
All right, Sue, that statement, what does it say?
Yeah, so the Reserve Bank is saying that conditions in the housing market continue to vary considerably around the country, which was similar to the last statement. In some markets, conditions are strong and prices are rising briskly, but they notice in other markets prices are declining. Again, they note that in the eastern capital cities, there is a considerable additional supply of apartments scheduled to come on stream over the next couple of years, which will weigh on prices. But the key thing is they've mentioned this recent crackdown by APRA, the banking regulator, on Friday, and we've also seen ASIC, the corporate regulator, saying they're going to target interest-only loans. APRA announced crackdowns on interest-only loans on Friday and also told banks they have to keep the speed limit on investor loans comfortably below 10%. They've added an additional statement here saying by reinforcing strong lending standards, the recently announced supervisory measures should help address the risks associated with high and rising levels of indebtedness. They also target specifically the lenders. They say that the lenders need to make sure that people can repay their loans, that the serviceability metrics they use are appropriate for current conditions. A reduced reliance on interest-only housing loans in the Australian market would also be a positive development.
This is really what they said at the last statement there, John, isn't it?
Yes, they've added a little bit more about the macroprudential measures, and also too they're having the stability assessment is going to be coming out on April 13th. There's financial stability. Now, they've been briefed about that today, so they have more details on exactly where that stands. And I think that they're going to be using this targeted measure rather than monetary policy. Monetary policy is such a blunt instrument, and they're targeting it. And they're going to have to keep tweaking it as well, because in 2015, they took similar macroprudential measures. They worked for a while, but then, of course, the borrowers and lenders find some way to get together again, and the party started in the housing market again, in the speculative side. And the RBA has said for years now, and Glenn Stevens before Philip Lowe was saying that they don't really think that it's very helpful for the economy for people to get wealthy on property speculation. They don't see that as part of a mainstream of the economy. And so I think they're going to be discouraging that to a great extent now.
And interest rates in the States have been heading up, which will push the greenback higher, depressing our dollar, which is, the Reserve likes that, doesn't it?
Absolutely. The Reserve Bank was one of the reasons that they lowered rates recently in the last few years was because they were worried about the Australian dollar gaining strength. But now that the U.S. Federal Reserve is on the tightening cycle, there's less fear that the Australian dollar will suddenly run to the upside, and which would kneecap the recovery.
How is the dollar doing quickly?
Yes, we've seen the dollar fall. It was just above 76 US cents before the announcement, and now it's buying around 75.8 US cents. And the share market's fallen slightly as well after the Reserve Bank decided to keep interest rates on hold at 1.5%.
There you go. That's the latest news. Reserve keeping rates at that record low. Lannin, our finance reporter, and John Noonan from Thomson Reuters. Thank you both.
Thank you, Russ.